Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Welcome to my latest video. In this video, I want you to learn from my mistake. I made a mistake this week, and I'm kicking myself for doing it. I knew it was wrong when I did it, but I broke my own rules, and I go into that, okay? If you like this video, please give it a thumbs up. If you want the next one, hit that subscribe button and the notification bell. Don't forget the bell, okay? If you hit that bell, you'll be notified when my next video comes out, and you get it straight to your inbox. Okay, let's get into it. Scaling in. Okay, it's essential if you want to make money. It's highly probable that you will make a mistake, okay? And if you make a mistake, it's good to make a small mistake. And that way it can be corrected, all right? I made a mistake this week. I can't believe I did it. It was FOMO, essentially, fear of missing out. And I'll tell you what I did. So getting the right price, right, is the most important thing if you want to make money in stocks or shares. The old saying, buy low, sell high. But when emotions are involved and you're watching a stock and you think, it's going to the moon, it's so easy to jump in and get the wrong price. I did this. You can buy a bad company at a good price and make money. You can buy a good company at a bad price and lose money. And that's what I'm in danger of doing right here. I'll show you why. So fortunately, I scaled in, so the mistake is small. So hopefully I can correct it. Now, this is the company, Manolete Partners. And I think this is going to be a massive area, okay? At the moment, the recession hasn't started, the financial fallout hasn't started. I keep saying this. I keep likening it to a patient that's in a coma, induced coma. That's what the economy is in. It's no wonder all the sales figures are down, jobs are going up. Of course, because, you can't go shopping, you can't go and buy anything, you can't leave the house pretty much. So, of course, the sales figures, all kinds of metrics are off, just falling off a cliff. We want to know what it will be like when we reopen. Now, if you look at the unemployment figures, it doesn't look very good. In America, we are talking historic. We've never seen unemployment like it. This is the biggest economy in the world, America. Never seen anything like it since the 1930s. And that was a 10-year depression. This time round, hopefully, the government are ploughing more in, economies are more flexible, they respond faster. All right? But even if 90% of people go back to work, okay, in America, quickly, and sometimes that doesn't happen. If 90% go back to work quickly, then it will still take years to recover. And they'll still have an unemployment rate bigger than the last 5, 10 recessions. So it's still big numbers. So this is why I think, companies like this, Manolete is UK's leading insolvency litigation financing company. So they specialist in insolvency financing company. They fund or buy insolvency claims. And I read somewhere they've never failed in a claim. They work with insolvency practitioners and their lawyers to maximise returns for creditors. We are renowned for unparalleled knowledge in the insolvency and recovery sector. So this is my spreadsheet of their last set of interims, which I compared to a previous period. Turnover is not massive, of course. Massive margins, though, 57%. That's huge. And so their profit before tax was 4.2, and the growth here. So this is all the metrics here I punch in. This is interims, by the way, 6 months. So, of course, it's going to be more than double that because they're growing faster. So the growth metrics here are impressive. The revenue wasn't huge, 15%. That's half year and half year. Profit growth up 42%. Cash growth up 214%. Profit margin growth up 23%. Retained earnings growth up 226%. Operating cash flows down because they acquired a company. Net current assets up 110%. Net asset growth up 203%. Amazing growth fund. Now, this is an issue here which I've overlooked. I'm focused on growth, for this kind of company I'm focused on growth, but it's always going to look at valuation, and their PE, which you have to divide by 2 because interims, is pretty much half of that, which is, it's quite high. It's close to 30. A PE 30. Anyway, health, all good stuff on your health. Again, the operating cash flow margin went down because they acquired. It's down a little bit there, but the score of 58%, so it gives me a score of percent. That's around right here. It would have been higher if they hadn't acquired and they had more, more cash. So it's looking good. This is an update they did on the 4th of May. Okay, this is case inquiries to them from 2019 2020, up 129%. If you look at that, the metrics on every month, look at January went mad. And it says January inquiry level was particularly high, reflecting the inclusion of an unusually large block of 21 cases from a single insolvency practitioner. So that's inquiries. These are new cases signed, again, up 115% for the year. So it's looking good. What's annoying about this is I bought this company before the crash, because I thought the economy's getting worse. There's going to be, this company is going to be doing well. All the financial metrics are good. The CEO, Stephen Cookling, says, this crisis is likely to lead to widespread global economic disruption. We expect that there will be unavoidable knock-on effect for the UK economy, and we would expect this to lead to an increase in case referrals to Manolete in the months to come. This is the market leader there in UK insolvency. There's a lot of companies out there. There's Fairpoint, FRP, there's Begbie's. Those companies, they do have other parts of their business. This is pretty much a pure play on insolvency, so they leverage this. And but I was watching it because I'd sold when the market started selling off, because I wanted to just get into cash a bit. I was really just, I wasn't specific at just selling, dashing for cash like everyone else at the moment, and it just held on to a couple of stocks. I paid down a lot of my existing holdings and sold off a lot more, and this was one of them which annoyed me, which I should have looked deeper and thought, hang on, it's going to be good for them, but a bit of a panic. So the thing is, I broke my own rules when I just bought this now. I was watching this for ages. I watched it come back, and it was way over where I should have been. This is the rule I broke. So I always put these companies through these filters, and this one is about the chart. Is the relative strength index above 30 and rising towards 50? So it's in recovery mode after a sell-off. That's where the momentum's in the right place. It's not going to continue down, because if it's below 30, it could continue being oversold, all right? So there's two ways to fix this. First of all, I've added this to my spreadsheet. This is the gain I'm looking to achieve in these sectors, in these risk sectors. These are pre-revenue big stocks. If you notice, with Salt Lake, I'm at 44 already. I'm looking for 300% return on that. These 100% pretty much over 3 years. This is, by the way, and this is around 30%, the bigger ones. Why? So you're probably thinking, well, why not just go for all the sector? Because some of these won't make it to that. Some of these are higher risk. These are lower risk, but decent rewards. There's more probability of this happening, and this is what I've come down to: probability, right? So I've done that with one of the ways to fix what I've done. It's pure emotion. Fear of missing out. I'll show you the chart. Here we go. There's a chart. So this is where I bought previously. Okay, around about here. All right, and then dash cash happened. I probably dumped it around here, lost a bit of money on it. Came down. I shot my way back up, and I sort of bought up here. Now this is where I suggest in my rules I buy a stock. Okay, I didn't. I was looking elsewhere, and I really sort of cottoned on. How thick I am, that insolvency is a good thing. These are companies that are going to thrive, not just survive, okay? Now, it's always worth having these in your portfolio. Yes, there's going to be recovery plays. I've got those in my portfolio already. I've got the big cap stocks like Greg's, Barrett, and what else is it? Greg's, Barrett. What else is it? Another big stock, and Auto Trader. So they are my recovery stocks. But I want one. I said in my growth stocks, I've got Tristel, which is a thriver. It's in infection control. But I wanted a sort of a thriver in my big cap stocks. But I sort of Manolete. I thought that's going to be a thriver. So I'll have two thrivers during this downturn in my growth story. And that's when I come to this. And I was watching it all the way up. I was watching it here, watching it here, watching it here. And I thought, it's never going to come back. All stocks come back. Learn from my mistakes. All stocks come back. So this is where, like I said, I should have bought, okay, which was between 30 and rising towards 50. All right, there's 30 there, it's 50. This is where I actually bought the wrong end. So what do I do here? I can either, okay, to sell now for a loss and just get a better price, wait until my rule comes back into play, until it comes back down here. It doesn't have to go below 30, just have to go from 30 towards things. So it's going in this direction. So I can either do that or I can scale in. Now what I'm going to do as well, on every stock I buy, if you look at a stock's trading range, and I'll do it here now, I've come up with this probability traffic light system for buying and selling. Okay, let me put myself up here. And I'll show you how this works. Hopefully this will help me in the future. So in this indicator here, this is TradingView. I've done videos on TradingView before. Click that, and you get all these things that come out. Now, a lot of people use Fibonacci, retracement. I don't really use Fibonacci retracement, but I have used it. You can change the variables on it. So now I'm going to use this. So you get the bottom of the range, okay, and the top of the range. So as you can see there, the highest it's ever been is up there, and the lowest it's ever been is down here. Essentially, it's a trapper-like system. It's all about probability. Stocks and shares are all about that, okay? Essentially, if you're in this area, the lowest range has ever been, there's a higher probability it will go higher from here, okay? If you're in this range, it can go any way. It can go this way or this way. So it's amber. Oh, yeah, you're going to be an amber gambler, essentially. You know, do you want to go, are you going to buy here? Now, if the momentum's right, but they say that, you know, looking at the moving averages, they're ticking down here, so I shouldn't have even bought there anyway, really. I should have only bought there. Now, if you're in the red zone, you had a previous high. Look, it's touched this before. It's a good chance. There's a high probability it's going to go down. Now, if you only work on probability, you'll do well in life generally. If you look at the odds and the probability, I've said this before about, you know, investing in companies. You know, you've got to sway the odds in your favour, and you do that in certain ways. And one of the ways is just by looking at the share price. And so I'm now going to do this with every stock I look at. I'm going to say, is it in the green area? That's perfect. You know, and then look at this area here. I mean, if it comes down here, like I said, and it bounces back up, it's still quite risky. But if you're going to scale in here, it's a lot easier to scale in here. Now, this share price could go further up. I'll be sort of okay. I'll get away with it. But the chances of me making money when I buy down here are a lot better than the chances of me making money when I'm buying up here and it's hitting previous highs and it's failing to get above that previous high. That's a double top, pretty much. So this is why I come to this probability. And essentially, I split these into thirds. Ignore the lines in the middle, but I'm just saying, you know, if you can get below that, look at that. Every time it's been this level, it's good. Every time it's been this level, it's good. Now, you know, when you get this level, it gets a bit choppy. Choppier, coming down. Higher lows, lower highs, I mean. And it comes down here. So it's basically this thing. Now, how can I correct this? In fact, let's look at some of those stocks. For example, what some of those stocks have been quite hot of late? So let's look at, let's look at Barrett Developments, for example, I've got. Look, it's in the green zone. So if I've scaled back here, and it doesn't matter how far you scale back several years, you know. Look, you're going back to 2017. If I go back to 2017 and grab this and bring it down even, it's still in the green zone, you know. So, you know, the chances of you doing well when it's in the green zone are very good, but also wait for the RSI to come out there. Green zone, if you're going to buy in the red, look at the red. You buy in the red zone, danger. It's a good chance it'll come back. It's a high probability that it'll come back. Simple as that, you know. And that's what stocks and shares are about. Buying low, selling high. Simple as that. So what you do is buying the green, selling the red. And that there is a decent return. Look, that's almost 100% pretty much. If you're buying the green, selling the red. Let's look at Greg's. GRG. I've done it here as well. I've gone back. In fact, you don't have to go back that far because that's the low for 2 years. But even with Greg's, if I go back to, say, what? 2018. We're in the amber here. We're in the amber. Now, it did pop down in the green, got oversold, came back up. This is the buy zone, right here. The buy zone in the green, RSI going from 30 to 50, that's the buy zone. Now it's bounced off this. This is obviously 33% there. Oh, 66 retracement. It's bounced off that, but hopefully it'll come back into this buy zone. I think it will retest that once for the financial fallout. So you can see some most stocks. I mean, let's look at Halfords has had a good run of late. Fibonacci there. We're now in the red zone. Buy zone pretty much is 95, but run about 95 pence or a quid. All right. Let's look at another hot stock like NCYT. Look at that, still in the red zone. It's coming in the orange zone actually now. It's calmed off. The overside, it's a heck of a run. Look at that. It's gone from like 6 pence to what? 5.20. That's nuts, isn't it? Yeah, phenomenal run. Phenomenal. It's going to cool off. Of course it is. but you know, you're better off buying here than you do up there. Except the red zone right up there. If you come back to the green zone, and they're doing, you know, tests, and all that, it's a buy, of course. They're selling those tests, and we don't know the financials there. RSI is coming down here, looks rolling over. Momentum's lost. Momentum was really high here and here. Look at the momentum here. What else is there? I tell you what, TSTL, Tristal, which is a thriver, not a survivor in this kind of economy. Let's go from there to there again in the red. Let's go back a bit because that's not very far range. So the range you can take as much as you want. If you want to be from the safe side, let's go back to 2018. 320. Look at that. It dipped into that. Orange. Look at the trend on this though. I mean, they're expanding by 20% anyway, and they're in infection control, so they're expanding by 20% before COVID came in. But so what do I do now? Well, listen, the power of scaling, like I said, is phenomenal, because look at this sheet here. So let's go back to Manolete a second. Mano. Okay. And let's just hit that. All right. So my first buy says 560. Right, that's in the red zone. No good. Now I'm looking on the scale down model. You can get this, by the way, if you look below these spreadsheets. And I'm just saying, let's say your portfolio is worth 10 grand. Okay, I'm just saying that to round figures. It doesn't matter what you put in there. You can put 100 grand in there. Same kind of things. It fills it out for you. But let's say my first buy is at 560. All right. Then I decided to go for 3 scaling ins at 20% drops, because I've really got, and I need the 20% because I've really messed up my first buy. If your first buy is good, you know, if your entry is good, your exit can be good. I mean, Salt Lake Potash is a good example of me getting in at the right time. Like I did my video on Salt Lake Potash, and check it. It ticks every box. The chart was right. Everything was right. This one I had FOMO. I've got to be more of a robot, less emotion. So let's say 20% I scale in. So 448, 358, 448, which is which is right here. Yeah, in the 358, still twice in this area here. If I get that right, this is what happens. Look, so I buy in this zone here. It's the share price is here. If it goes down to £2, I'll be 56% down if I'd scaled in anyway. But I can start making money at 450, of course, because my average would be 440. All right, so if I'd scaled in, I can still be in the money at 450, which is pretty much here, which is not bad. It's in the orange zone, you know. Ideally, my average would be down here, but I can rescue this by scaling in and let it pay out. Now, if the share price goes higher, of course, I'm fine. But I'm saying if it stays in this range, I think it'll break out. I mean, I just think their increased profits and revenue and businesses here, they should see a breakout. But if it doesn't break out, I'm playing a dangerous game here by actually, you know, buying in, scaling in, starting my scaling at the wrong level completely. Like I said, because £5, I want to get to, 100% off this. So 650, I'm only 47% up. And 650 is what? The top of the range, pretty much. Yeah, so ideally, I want my 100% on this, my target, to be at the top of the range, or even nowhere near that, you know. So if I'd got my price around this level, like I said, at £2.80, I'd already achieved my 100% target. So I've missed out already. I've really messed up. So that's what I'm going to use. This is my, I'm trying to get a catchy name. This is my traffic light probability buy or sell indicator. And I'll be using this in all stocks now, just to check that it's in the right zone, and then it's coming up, on the momentum here. I'm not breaking my own rules. It's one thing having rules. It's good to set rules. I set those rules from, just years of trial and error and looking at things and reading and back testing and all that stuff, in the cold, sober light of day, and then you get into the market when the market's open, and you just, act on emotion, fear of missing out, and you make a silly trade. So it's up to me now whether I try and correct that. I do like the company, a very good company, or I just try and get out for a small loss or something. But we'll see. But it's a counterintuitive play on the economy. The economy will go down, this company will go up. And that's worth having a couple of those in your portfolio. Of course, this is not the right time to buy. Learn from my mistake, all right? Thank you for watching. If you made it this far, give it a thumbs up or share it. And listen, if you want the next video to your inbox, click my face, which is right by there, and then hit the notification bell, and you get notified to your inbox when I release a next video. And normally once a week. I do, maybe once every fortnight, but no more than that. And you'll be notified, and you get to watch it straight away as it comes out. If you want to watch some more videos, by all means, there's some right there. Thanks so much for watching.